Mortgage rates just dropped below 6% for the first time in 3 years. Every headline is telling you the same thing. Now is the time to buy a house. But here's what almost nobody is talking about. If you take that exact same down payment and put it into the stock market instead, the math says you could end up with $200,000 more in 10 years. I'm going to show you the actual numbers, not opinions, not it depends, real math. And by the end of this video, you'll know exactly where your next dollar should go. If you've been saving for a down payment for the last year or two, or if you're sitting there wondering whether renting and investing the difference actually beats owning, this video is built for you. We're going to walk through what real estate actually returns, what stocks actually return, the one factor almost every finance video leaves out, and the exact number where the decision flips one way or the other. No fluff. Let's get into it. Let's start with the case for buying a house, because it's a strong one. And it's the reason millions of Americans have built their wealth this way, for generations. Right now, the average 30-year mortgage rate sits right around 6%, down significantly from the 7.8% peak we saw a few years back. That's a meaningful drop. On a $400,000 home, that difference alone can save you hundreds of dollars a month. Home prices, meanwhile, have actually cooled off. National home price growth was under 1.5% last year, one of the slowest years in over a decade. So you're not chasing a runaway market anymore. Add to that the crystal arguments. A mortgage is forced savings. Every payment builds equity, instead of disappearing into a landlord's pocket. You get tax deductions on mortgage interest. You get a hedge against inflation, because your payment is locked in, while rent keeps climbing. And you get something you can actually touch, live in, and control. Nearly 40% of Americans say they're planning to move this year, and a huge chunk of them are weighing exactly this decision. If you ask most financial advisors from your parents' generation, the answer is obvious. Buy the house, build the equity. That's the safe, time-tested path. So far, this all sounds right. Real estate seems like the obvious winner. But here's where it gets interesting. Let's look at what actually happens when you compare the raw returns side by side with real historical data. The S&P 500, which is just a basket of the 500 largest U.S. companies, has averaged a little over 10% a year going back more than 3 decades, including dividends reinvested. That's not a cherry-picked number. That's the long-run average through recessions, crashes, and recoveries. Real estate, measured by the National Home Price Index, has averaged roughly 5.5% a year over a similar stretch. Let that sink in. Stocks have historically grown at almost double the rate of housing. Now picture this. You take $50,000 and you put it into the stock market. You take another $50,000 and you put it into a house as a down payment. And the house itself appreciates at that historical real estate rate. 10 years later, the stock portfolio has grown to roughly $130,000. The home equity from appreciation alone has grown to about $85,000. That's a $45,000 gap, and we haven't even gotten to the part that makes this number so much bigger. So if stocks outperform real estate by this much, why does almost every financial guru still tell you to buy a house? Here's the answer, and it's the part of this debate that almost nobody explains correctly. But wait, here's the part that completely changes the math, and it's the reason real estate has built more generational wealth than almost any other asset class in America. It's called leverage, and it works like this. When you buy a $400,000 house with a $20,000 down payment, that's just 5% down. You don't just own $20,000 worth of house. You control the entire $400,000. The bank is funding the other 95%. So when that house appreciates, you're not earning a return on your $20,000. You're earning a return on the full $400,000. If that house goes up just 5% in a year, that's $20,000 in appreciation on a $20,000 investment. That's not a 5% return. That's a 100% return on your actual cash. Stock investors almost never get this kind of leverage. Brokerages limit margin borrowing specifically because leverage is dangerous, and most people simply invest with cash they already have. So when you account for leverage, real estate's effective return on your actual invested cash can blow past the stock market's unleveraged return, at least on paper. This is the single biggest reason real estate has created so many self-made millionaires. It's not because houses are magical. It's because the banking system lets ordinary people borrow huge amounts of money at relatively low interest rates to buy an appreciating asset. But here's the part. Most real estate content completely leaves out. Leverage cuts both ways. If that same house drops 5% in value, you haven't lost 5% of your money. You've lost 100% of your down payment. This is exactly what happened to millions of homeowners during the housing crash years ago. The leverage that builds wealth on the way up destroys it just as fast on the way down. Stocks don't typically work this way for the average investor. If the market drops 20%, your portfolio drops 20%. Painful, but you haven't lost your entire investment. And historically, the market has always recovered, given enough time. So leverage isn't a free win for real estate. It's a multiplier, and multipliers amplify both gains and losses. Now let's go back to that $200,000 number from the beginning of this video, because this is where the real-world decision actually lives. Here's a true-to-life scenario. Say you're 28 years old and you've saved up $40,000. You're deciding between two paths. Path 1, you use that $40,000 as a down payment on a $350,000 home, take out a mortgage at today's rates, and live in it for the next 10 years while paying down the loan. Path 2, you keep renting a comparable place, and instead of using that money as a down payment, you invest the full $40,000 in a low-cost S&P 500 index fund and leave it alone for 10 years. In Path 1, factoring in your mortgage payments, property taxes, insurance, maintenance, which typically runs 1 to 2% of the home's value every single year, and the appreciation on the home itself, your total net worth gain from the property after a decade lands somewhere in the range of $90,000 to $120,000, depending on your local market. In Path 2, that same $40,000, growing at the market's historical average, turns into roughly $105,000 in pure investment growth alone. And unlike the house, you never had to pay for a new roof, a broken water heater, or property taxes on it. Now here's the part that creates the real $200,000 swing. If you're in one of the more expensive metro areas, and right now, buying is actually the cheaper option in fewer than half of the largest cities in the country, the gap between renting and investing versus buying can stretch well past $150,000 to $200,000 over a 10 to 15-year period, once you account for the opportunity cost of that locked-up down payment, ongoing maintenance, and slower local appreciation. If you're in your late 20s or early 30s right now, sitting on savings and trying to decide what to do with it, this is the exact decision in front of you. And the honest answer is, it depends almost entirely on where you live and how long you plan to stay there. So when does renting and investing the difference actually come out ahead? There are 3 conditions where this becomes the smarter move, and almost nobody puts all 3 together in one place. Reason 1, your time horizon is short. Buying a home comes with massive transaction costs, closing costs, agent commissions, moving expenses. That can eat up 8 to 10% of the home's value between buying and selling. If you're not planning to stay put for at least 5 years, those upfront costs alone can wipe out any equity gain you'd have made. Reason 2, you're in a high price to rent market. Some cities have home prices so disconnected from local rents that buying simply doesn't make mathematical sense. In these markets, renting and investing the difference isn't just competitive with buying, it actually wins, sometimes, by a wide margin. Reason 3, you'll actually invest the difference. This is the one that trips up almost everyone, and it's the most important condition of all. The entire rent and invest strategy only works if you genuinely take the money you save by renting and put it into the market every single month. If you rent and spend the difference on lifestyle upgrades instead, you lose every advantage stocks have over real estate. This is actually the hidden strength of a mortgage. It forces discipline that most people don't have the willpower to enforce on themselves. That third point is honestly the most important thing in this entire video. A house works because the bank forces you to pay it every month, whether you feel like it or not. The stock market has no such enforcement mechanism. It only works if you do. Now, when you put all of this together, a clear decision framework starts to emerge. The first rule is, if you're planning to stay somewhere for less than 5 years, renting almost always wins. Full stop, because the transaction costs of buying and selling that quickly are too steep to overcome. Rule 2. If you're staying long-term, 7, 10, 15 plus years, and you live in a market where the price-to-rent ratio is reasonable, buying tends to win, primarily because of the leverage effect we talked about earlier, even after accounting for maintenance and taxes. Rule 3. If you're someone who knows, honestly, that you won't consistently invest the difference if you rent, buy the house. The forced savings mechanism is genuinely valuable for people who struggle with investing discipline. This isn't a knock on anyone. It's just being honest about human behavior. Rule 4. If you're disciplined enough to actually invest every single month without fail, and you're in an expensive market, or you might relocate for a job in the next few years, renting and investing can realistically outperform buying, sometimes by that $150,000 to $200,000 margin we talked about. The real answer isn't real estate is better or stocks are better. The real answer is that real estate is a leveraged, forced discipline asset that rewards staying put, while stocks are a higher raw return, flexible asset that rewards consistency and patience. Most people don't lose because they pick the wrong asset. They lose because they either bought a house they couldn't actually afford to maintain, or they planned to invest the difference and never actually did it. So, which path are you on right now? Saving for a down payment or investing instead? I'd genuinely like to know. So drop it in the comments, because the answer is different for almost everyone watching this. If this video gave you real clarity, instead of leaving you more confused, then it means the hours I spent making it were worth it. And if you feel it earned your support, I'd really appreciate it if you subscribe to the channel.